There's a conventional millionaire right now, someone who built most of their wealth through ordinary income and maxed out traditional retirement accounts, whose $500,000 balance is headed straight for a tax bill they never modeled. A 4% annual withdrawal combined with Social Security income is enough to push their income high enough that up to 85% of their Social Security benefits become taxable. And the person across the street with half the balance is going to retire cleaner, longer, and with more money to spend. Not because they got lucky, because they understood the difference between what they saved and what they actually get to keep. Here's what's even more uncomfortable. The 4 mechanisms I'm about to walk you through are completely invisible in every standard retirement calculator you've ever used. The industry built its tools around your balance, not your structure. That was not an accident. When clients first walk into a financial planner's office, they often ask the wrong question. Have I saved enough money to retire? The real question is, will I outlive my income? Those are very different questions with very different answers. And the person who's been asking the wrong question for 30 years, even diligently, even responsibly, can retire worse than the person who asked the right one with half the resources. I've been watching this play out firsthand for years, with my own money in the market and a decade plus of being surrounded by accountants and fiscal lawyers who explain to me, in very direct terms, exactly how money moves when it leaves your account and enters the federal tax system. What I'm about to show you took me years to fully understand, and it should take you about 20 minutes. Let's go. Here's what this video is going to do. I'm going to explain with real numbers, you can verify why someone with $250,000 structured correctly will consistently out-retire someone sitting on $500,000 structured wrong. I'm going to walk you through 4 specific mechanisms, not philosophy, not vibes, actual mechanics with dollar amounts attached that are silently destroying larger retirement balances every single day in this country. And I'm going to give you a framework that, once you see it, rewires how you look at every retirement account you've ever opened. The reason this has gotten so broken is simple. We built an entire financial culture around a single number, the balance, the scoreboard, the number you check at 3 in the morning when you can't sleep. But the scoreboard doesn't tell you how much the government takes, how much your fund manager takes, how much market timing takes, or how much the pre-Medicare healthcare gap takes. The scoreboard is the gross number. And nobody retires on the gross number. Think about your salary for a second. If you earn $100,000 a year, you don't actually earn $100,000. You earn whatever's left after federal taxes, state taxes, FICA, and health insurance deductions. Maybe $65,000, maybe less in a high tax state. The $100,000 is your gross. The $65,000 is your net. That's the number you live on. Everything else is a label on paper. Your retirement balance is your gross, the number on your statement, the number people post on financial forums, the number you compare yourself to at a dinner party. But taxes, fees, market sequencing, and healthcare carve into that number every single year until what you actually spend bears almost no resemblance to what you saved. And the person with $250,000 who built their pile correctly, they might have a gross to net conversion rate near 90 cents on the dollar, almost all spendable. Your balance is your gross retirement. Where's your net? That question is the spine of this entire video. Every section is an answer to it. In a few minutes, I'm going to show you the mechanism that hits hardest, one that has nothing to do with taxes and everything to do with the order in which bad things happen to your money. But first, here's why the tax structure on large traditional accounts is even more broken than most people realize. Meet Marcus. He's 52. He's been disciplined in a way that most people genuinely aren't. He maxes 401k for 25 straight years. He's sitting on roughly $500,000 in a traditional pre-tax account. No Roth IRA, no taxable brokerage, one account type. He was told correctly that his 401k grows tax deferred. What nobody told Marcus with equal emphasis is that tax deferred doesn't mean tax free. It means tax later. And later has a specific name, a specific age, and a specific mechanism that makes it worse than most people model. It's called a required minimum distribution. The IRS uses required minimum distributions to force withdrawals from traditional retirement plans. If you were born in 1960 or later, you must make these withdrawals upon turning 75. But RMDs start at 73 if you were born between 1951 and 1959. On Marcus's $500,000 traditional account, the first RMD at age 73 using the IRS Uniform Lifetime Table Divisor of 26.5 comes out to roughly $18,900 mandatory, taxable as ordinary income. Added to everything else he receives that year, here's where the gross versus net problem detonates. That mandatory income can push retirees into higher federal tax brackets, trigger the taxation of Social Security benefits, and raise Medicare premiums by thousands of dollars each year through a mechanism called IRMA. A small withdrawal from an IRA or a required minimum distribution can trigger a domino effect, suddenly making more of your Social Security taxable. The result is that each extra dollar of income can feel like it's being taxed twice, once as ordinary income, and again because it pulls more of your Social Security into the taxable column. The combined income of an RMD and Social Security income can push income into a higher tax bracket, increasing federal income tax bills, state and local taxes, and capital gains tax imposed on selling investments. And the Medicare IRMA surcharge is where the pain gets specific. The IRMAA brackets function as income cliffs rather than gradual phase-outs. Crossing a tier by even $1 triggers the higher premium rate across the entire Part B cost, not just on income above the threshold. RMD divisors shrink every year while balances continue to compound, so RMDs commonly trip the first IRMAA bracket between ages 75 and 77. Once tripped, combined Part B and Part D surcharges run $1,148 to $6,936 a year, on top of the standard $202 monthly Part B premium. This is what financial planners have started calling the Tax Torpedo. It's an unexpectedly steep jump in your tax bill, even though your lifestyle hasn't changed. The torpedo isn't one thing, it's a cascade. One mandatory withdrawal triggers higher income, which triggers Social Security taxation at up to 85%, which triggers IRMA surcharges, which collectively erase a meaningful percentage of every dollar Marcus saved. If you have $1 million in the TSP or a traditional account, you don't actually have $1 million in spending power. Because when the money comes out, they're gonna withhold taxes, say 30% for federal and state taxes, which means you only really have $700,000 in the traditional account. Now, here's the person with $250,000. She also saved diligently, but she diversified her account types, $100,000 in a Roth IRA, $80,000 in a taxable brokerage account, $70,000 in a traditional IRA. When she retires, she pulls from her Roth and taxable accounts first. By keeping taxable income low, she can control her tax bracket and make Roth conversions more effective. This approach allows her to minimize her tax liability in the early years of retirement. Her modified adjusted gross income in early retirement is low enough that 0% of her Social Security is taxable, low enough that she pays the baseline Medicare premium and nothing more. Her Roth IRA withdrawals don't count toward the IRMA calculation at all. Retirees who built Roth balances during their working years gain the flexibility to control their annual distributions rather than having the IRS impose a mandatory withdrawal floor. She has $250,000 gross. She has roughly $235,000 of effective net spending power, maybe more, depending on how she times Social Security. Marcus has $500,000 gross. After the RMD taxes, the Social Security taxation cliff, the IRMA surcharges, the bracket creep, he nets approximately 65 to 70 cents on every dollar. His $500,000 effectively delivers the spending power of $325,000 at her marginal rates. She retires richer, with half the balance, because her gross and her net are nearly the same number. Your balance is your gross retirement. Where's your net? Now stay with me, because this next section is where the trap gets completely counterintuitive. You're gonna think the problem is losing money in a bad market. The actual problem is far more specific than that, and the person with the smaller, better structured balance survives it in a way the larger account simply cannot. Sequence of returns risk, sometimes called sequence risk, is the danger that the timing of investment losses early in retirement will permanently reduce how long your savings last. This is not just an abstract risk. Research by Wade Fall estimates that approximately 77% of a portfolio's final retirement outcome can be explained by the returns of just the first 10 years. That statistic should stop you cold. Mathematically, average returns don't tell the full story. A portfolio taking withdrawals is permanently impaired by early losses in a way that a portfolio purely growing with no distributions is not. The mechanism is this. When you tap into your portfolio as it's losing value, you have to sell more investments to raise a set amount of cash. Not only does that drain your savings more quickly, but it also leaves you with fewer assets that can generate growth and returns during potential future recoveries. Here's what the numbers actually look like. Consider two hypothetical retirees, each starting with $1 million, taking $40,000 in annual withdrawals, and achieving identical 6.5% average returns over a decade. The retiree experiencing early negative returns ends with $880,000, while the retiree with early gains accumulates $1,358,000, a difference driven purely by sequence. Same average return, same withdrawal amount, same starting balance, a $478,000 difference from market timing alone. Negative returns during the first 5 years account for 70% of retirement plan failures, creating a compounding depletion effect that limits recovery potential even when markets eventually rebound. This is where the smaller balance wins structurally, and the reason is elegant once you see it. The person with $250,000 in a diversified account structure pulling from Roth funds, living partially off Social Security income, keeping the required portfolio draw rate low, doesn't need to extract as much from their investment account every month. Their portfolio withdrawal rate might be 4 to 5% annually. The person with $500,000 who has no other income sources and is funding their entire lifestyle from one pre-tax account might be pulling 20 or 25% of their portfolio annually. Morningstar's 2025 research found that retirees who experienced poor returns in the first 5 years and did not adjust their spending were far more likely to go broke. You can have an outstanding average return over a 30-year retirement and still run dry if you're pulling too much out during the down years at the start. You can have strong average returns over 20 years and still run out of money if the losses are concentrated in the first few years of retirement. Early retirees may rely on their portfolios for 30 to 40 years. That long horizon magnifies the effect of early losses and inflation. Without a plan to buffer against early market downturns, financial independence can turn into financial fragility. The larger the single account, the higher the mandatory withdrawal rate, the more catastrophically exposed you are to sequence risk. The smaller account with multiple income streams and low required portfolio draws is a resilience machine by structure, not by luck. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Your balance is your gross retirement. Where's your net? Here is the part that never makes it into a standard retirement calculator. Knowing that your account structure matters more than your balance is one thing. Building an actual mathematical system around it, one that tells you the specific order to pull from accounts, the exact Roth conversion amounts to run between 62 and 73, the specific income threshold you need to stay below to preserve your ACA health insurance subsidies before Medicare starts. That is a level of planning most people never reach, not because they lack the intelligence or the discipline. Because the information is genuinely scattered across IRS publications, actuarial tables, and fee disclosures that most people have never read and have never been walked through as a connected system. I built a digital book called The Exit Code. It's 8 chapters of pure retirement research built on 50 years of actual data, no motivational filler, just the framework and the math. One chapter breaks down the dynamic withdrawal method, which replaces the rigid 4% rule with a system that adjusts to what the market is actually doing. Morningstar's 2025 research found that while a baseline 3.9% withdrawal rate provides high confidence for rigid spending plans, retirees who can adjust their withdrawal amount based on portfolio performance could safely start at rates as high as 5.7%, a substantial potential increase in retirement lifestyle for those willing to adapt. Another chapter walks through what I call the $14,000 invisible bill. The average annual healthcare insurance exposure for someone retiring at 62 before Medicare kicks in, and how your account structure either makes that bill manageable or devastating depending on whether your income counts toward your modified adjusted gross income. Your financial advisor is not going to hand you a document explaining all of this as a coordinated system. That's not a criticism. It's just the nature of an industry that earns a percentage of assets under management, not a percentage of the outcomes you actually achieve. The exit code costs less than one dinner out through the link in the description below. Every year this framework sits unused is a year the math compounds against you. That's not urgency for marketing purposes. It's just arithmetic. Now let's talk about the part that makes me genuinely, permanently amused. Because the only reasonable response to how completely this fee structure has been normalized is to find the humor in it. You're sitting on $500,000. Your advisor charges 1% per year. That sounds like $5,000 a year. Not great, but not catastrophic, you might think. Here's what 1% actually costs over time. The gap between a 0.1% fee and a 1% fee at 10 years is roughly $15,800. By year 20, it's grown to approximately $59,100. By year 30, it reaches $165,800. That's not a linear progression. The cost of the higher fee nearly triples between year 20 and year 30 because the compounding engine has a larger base to erode in the later years. The investor paying 1% instead of 0.1% surrenders roughly 22.4% of potential ending wealth over 30 years. At 1.5%, the loss climbs to 32.7%. On a $500,000 portfolio, that 1% fee doesn't cost you $10,000 a year. A 1% fee could shrink your portfolio by about 25% over 30 years, translating to nearly $1.9 million less on a $1 million investment. Nearly $2 million. Not to market losses, not to economic crisis, to a fee structure that charges you whether the market went up or down, whether your advisor made a brilliant call or a mediocre one. At $2 million in assets, you're paying $20,000 per year. At $3 million, $30,000. The work your advisor does for a $3 million portfolio isn't 12 times harder than for a $250,000 portfolio, but the fee is 12 times higher. I want to be clear about something. There are advisors genuinely worth their fees, the ones doing comprehensive tax planning, Roth conversion strategy, asset location across account types, Social Security optimization. If someone is preventing you from panic selling during a crash and helping you build a withdrawal sequence that saves you $50,000 in taxes, that 1% might be the best investment you've ever made. The math can work in your favor under those conditions. But if what you're paying 1% for is someone to put your money into a target date fund and call you once a quarter, there's an option to invest on your own for about 0.03% per year. Compare that to 0.7 to 1%, which is also touted as low cost, but is 30 times more expensive. The person with $250,000 who manages a simple 3-fund index portfolio at near zero fee is letting their compounding engine run clean. Every dollar stays invested, earning interest on interest on interest. The person with $500,000 who's been paying 1% for 20 years has already surrendered a meaningful portion of a potential retirement, not to bad luck, but to a structure that was never designed to optimize for their net outcome. Your balance is your gross retirement. Where's your net? Here's the final piece, and it's the one that locks all of this together in a way you can actually act on. It involves Social Security, the healthcare gap, and a decision window that most people either sleep through or are financially forced into. If you delay taking Social Security benefits, your monthly check will increase for every month you wait until age 70. You'll get an extra 2/3 of 1% for each month you delay after your birthday month, adding up to 8% for each full year you wait. 8% per year. Guaranteed. Backed by the federal government. The difference in 2026 between the maximum benefit for someone who retires early at 62 versus waiting until 70 is $2,212 per month. Every month. for the rest of your life. The average monthly Social Security check for retirees in 2026 is $2,071. The difference between claiming at 62 and waiting until 70 is larger than the average total monthly benefit. Think about that. But here's the structural problem. The person with $500,000 all in a traditional 401k has one source of liquid money. Their pre-tax account, every dollar they pull from it is ordinary income. They may need that income immediately at 62 to cover basic living expenses. So they claim Social Security early, lock in the permanently reduced benefit, and give up a lifetime income enhancement worth hundreds of thousands of dollars in present value. The person with $250,000 in a diversified structure pulls from Roth accounts in early retirement. Roth IRA distributions don't count toward MAGI. Withdrawals from a traditional 401k or IRA do. If you have both, drawing from Roth accounts first can keep your MAGI below the thresholds that shrink or eliminate your health insurance subsidy. They can sustain themselves from age 62 to 67 or even 70 without touching their taxable income. They claim Social Security at 70 with the maximum possible benefit. They've effectively given themselves an 8% guaranteed return on a government annuity for 3 years by having the right account type to bridge the gap. Now, for the healthcare piece, which is the subplot nobody talks about until they're living it. If you retire at 62, Medicare doesn't start until 65, 3 years. Without a subsidy, ACA marketplace premiums for a 62-year-old typically run $1,000 to $1,800 per month in 2026. That's $12,000 to $21,600 per year per person. 3 years of that before Medicare starts is a range of $36,000 to $64,000 per person in pure insurance premiums. According to Fidelity Investments' 2025 retiree healthcare cost estimate, the average 65-year-old who retired in 2025 will spend an average of $172,500 on healthcare and medical expenses throughout retirement, not including long-term care costs. And here's the counterintuitive part. The account sequence in question is where this gets interesting. Roth IRA distributions don't count toward MAGI. Withdrawals from a traditional 401k or IRA do. The person with $250,000 in a Roth-heavy structure keeps their MAGI low in early retirement and qualifies for marketplace subsidies that dramatically reduce that premium. The person with $500,000 all in a traditional account can't touch their money without triggering income that pushes them above the subsidy threshold and forces them to pay full market rate for insurance before Medicare starts. I know a guy who retired at 63 and paid $18,000 a year in individual health insurance in his first year out, not because he was reckless, because every dollar in his account was pre-tax and the ACA calculator treats every withdrawal as income. His neighbor across the street retired at the same age, with the same lifestyle, and paid under $3,000 annually in premiums because she'd spent years building a Roth balance specifically to keep her MAGI low in this window. Same market, same retirement date. $15,000 annual difference in a single insurance line item for 3 years before Medicare. That's $45,000. That is very nearly the entire balance differential we're talking about in this video, sitting in one line item. Marcus is back. Remember him? 52, 500,000 in a traditional 401k, no other account types. Here's how his story finishes. He retires at 65. He claims Social Security at 62 because he needs the income. There's nothing else liquid. He locks in the permanently reduced benefit. He begins drawing from his 401k immediately. His first full year of retirement generates $58,000 in income between Social Security and portfolio withdrawals. A portion of his Social Security becomes taxable. His effective tax rate is higher than he modeled. He doesn't find out about Roth conversion strategy, the window between retirement and age 73, until he reads about it online at 69. He does 2 years of conversions, moves about $90,000 to Roth, and then RMDs hit at 73 anyway and push his income above the IRMAA threshold. He pays Medicare surcharges for the rest of his life on top of baseline premiums. He's not destitute. He's genuinely fine in a conventional sense. But he's spending roughly 68 cents on every dollar he saved for 30 years, paying the structural tax of a single account type built over a lifetime of doing what he was told. Let's make the contrast concrete with real numbers. Person A, $500,000, all traditional, 401k, retires at 62, claims Social Security early at $1,800 per month, withdraws $24,000 from the 401k annually. Total first-year income, $45,600. After federal taxes, Social Security taxation, healthcare at market rate, net spendable income, roughly $31,000. Gross to net conversion, 68%. Person B, $250,000, $90,000 Roth IRA, $75,000 taxable brokerage, $85,000 traditional IRA, retires at 62, withdraws $10,000 annually from Roth, zero taxes, zero Maggie impact, subsidized healthcare under $3,000 annually, delays Social Security to age 70, net spendable income in year one, $22,000 to $23,000. But with nearly zero tax friction, subsidized healthcare, and a Social Security benefit growing 8% per year until 70. At age 70, their monthly Social Security check is dramatically larger than person A's permanently for life. Gross to net conversion, over 90%. Same market, different structure. Person B generates more actual retirement lifestyle per dollar saved. The scoreboard said $500,000 was twice $250,000. The net income statement said otherwise. And here's a financial advisor joke that's actually instructive. Two retirees at a planning seminar. One says, I have $1 million in a traditional IRA. The other says, congratulations, what does your accountant say it's worth? Silence. The second one is worth keeping. Americans say the magic number they need to retire comfortably in 2026 is $1.46 million. It was $1.26 million the year before. It goes up every year because people keep adjusting the wrong variable. They're inflating the gross number without fixing the structure that determines the net. Bill Bengen himself has called the 4% rule a very dramatic oversimplification of his research. Morningstar's 2026 research found that a baseline 3.9% withdrawal rate provides high confidence for rigid spending plans, but flexible withdrawal strategies like guardrails or adjusted RMD style draws can increase starting rates to about 6%. That's the difference between a rigid gross number and an adaptable net framework. The financial industry was structured around making your gross balance as large as possible. Advisors need you to stay as a client and keep your assets with them for their business model to work. This means they have less incentive to recommend actions that move your money elsewhere, even when those actions might be best for you. That's not malice. That's a fee structure. The people who figure that out early are the ones who retire richer with less on the scoreboard. 3 takeaways, specific to this video only. First, run a Roth conversion analysis between age 62 and 73. This is the window Marcus missed. Your income in early retirement before full Social Security, before RMDs, may be artificially low. That's when you convert traditional IRA dollars to Roth at the lowest possible tax rate. By converting pre-tax money to a Roth, you reduce the amount subject to RMDs in the future. Every dollar you convert in this window never appears in your IRMA calculation, never makes your Social Security taxable, and never triggers an RMD. The IRS hasn't closed this window, but it only exists for a finite number of years for each person. And every year you don't model it is a year of compounding tax exposure you could have avoided. Second, build the 3-account structure before you retire, not after. Taxable brokerage, Roth IRA, traditional IRA, or 401k. The sequence in which you withdraw from accounts is one of the most important strategies for tax-efficient withdrawals. A common approach is to draw from taxable accounts first, then tax-deferred accounts, and finally tax-free accounts, like Roth IRAs. The person with $500,000 in a single account type has 1 lever. The person with $250,000 spread across all 3 has 6 levers. 6 ways to manage taxable income every single year of retirement. Third, model your Social Security delay with real numbers, not rule of thumb advice. By waiting to claim your Social Security benefits until age 70, your monthly benefit will grow by 8% a year. A $1,000 per month increase in Social Security is equivalent to having $300,000 more in portfolio assets at a 4% withdrawal rate. For most people, delaying until 70 is the highest certainty guaranteed return available in the entire retirement toolkit. The only reason not to is a documented short life expectancy or a structural cash flow problem that forces early claiming, and if that problem exists, it is a planning problem solvable by restructuring account types before you exit the workforce. Lazy investing built more fortune than crypto memes. And if you're still measuring your retirement security by the number on your statement without knowing what the government, your fund manager, and the healthcare market are going to take from it, the IRS, the IRMAA brackets, the ACA income calculator, and the first bad year of returns are already running the math for you. They're just not sharing the results.